And they have something in the order of magnitude of $7 billion in cash on the balance sheet right now. But we think that they have the capacity to be able to issue in excess of $20 billion in debt without really straining the credibility of the balance sheet. That takes them to, approximately a little bit over 30% net debt to cap level. That's their stated upward end of the range, and I think that they could pretty easily do that. So as long as the unknown unknowns don't come up, we think that they're pretty well covered from a liquidity standpoint.
When investors are calling you trying to figure out what's going on, I mean, obviously you're not flying over the Gulf of Mexico right now, but what kinds of questions are they asking you?
Well, I think this liability issue is the big one, and then the other question that you really have to ask is this a stock that you want to be positioned in, or are there better places to put your money despite the big pullback that you've seen in the equity value?
Now, the stock is paying about 9% right now. Have there been questions about whether the dividend is going to be cut in order to help fund some of these potential issues?
It's a more recent phenomenon that the question on the ability to sustain the dividend has been coming up. We think that they are very able to sustain the dividend. I talked about the potential to issue incremental debt. That would assume that you're still paying that dividend that, as you say, is now yielding 9%.